Hi, good morning. This is Matt Sainholtz with Tobias Financial Advisors. We'll be starting our webinar momentarily. We will allow another 1 minute or two for some more additional attendees to get logged on, and then we will proceed. Thank you. Good morning again. This is Matt Sainholtz, Chief Investment Officer with Tobias Financial Advisors. Thanks for tuning in with us this morning. We are going to be recapping 29 market performance, talk about a little bit about the 2020 outlook, and overall just give an overall portfolio and investment market and economic summary and review. A little bit of housekeeping before we get started. On your webinar and our GoToMeeting capabilities here, there should be a question and answer section where you can kind of submit questions to us as we are going through the webinar. I'm going to save time for the end of the webinar to address any questions that we might receive during the presentation. And also, of course, this webinar is for general information only. You know, your unique situation or your unique goals would be different than maybe some of our other attendees. So just, you know, this is supposed to be general in nature. And if you do have specific questions about your situation or your portfolio or how we could help address your investing needs, please contact us here at Tobias Financial Advisors. So just to kick it off a little bit with just about who we are, Tobias Financial Advisors was founded in 1980. We are extremely happy to be celebrating our 40th birthday this year. So we will be celebrating that all year round. And we are a team of close to 15 individuals who have managed over $400 million in assets under management, mostly for private individuals. We do have some business retirement plans that we do manage, 401k type of plans that we do advise on as well. And we are really credentialed. One of the things that we do take very seriously is our continuing education. I myself is a chartered financial analyst, a CFA, as well as a certified financial planner. We have a couple CPAs on our team, and as well as some more certified financial planners. So we really value education, and that is part of today's mission as well, is just kind of further out education about what's going on in the markets and how to think about the portfolios going forward. Overall, general philosophy of Tobias Financial Advisors investment plan is, first of all, just really identifying your own goals and your own needs and what you're really investing for. One of the things that we'll be talking about today is kind of time horizon and looking at different time periods of returns. So we really want to create an investment plan that suits your needs and suits your risk tolerance when we're developing our investment strategy. Some folks might be able to take a little bit more risk as far as equities are concerned because they have a longer time period to retirement. So that's just one idea of how we structure our portfolios, but really want to kind of also focus on what we can control. Oftentimes, as you saw in 2018, and then fast forward to 2019, markets don't go in a straight line. They don't always cooperate as much as we'd like them to. So when we're structuring the portfolios, we want to diversify it broadly across U.S. and international countries and companies, different types of bond structures, whether that's maturity or the type of bonds, the credit worthiness of the bonds that we're holding. One of the things we can also control is expenses and how often we're returning over the portfolio and how often we're trading, as well as always want to keep an eye on good old Uncle Sam, minimizing the taxes where we can and making sure we're not taking too much short-term gains, for example, versus long-term capital gains. So these are all the types of things that we're considering, and there's also a few more that I'll get into on another more in-depth portfolio review, but there's also tax location, where to put the different types of assets, whether you have a Roth account or an IRA account or a 401k. That also goes into the calculation of how we're managing portfolios. Today's agenda, kind of touched on it already. We're really just going to review what's happened last quarter and the previous year and just kind of see what happened in 2019. And then we'll look at some upcoming events, what clients are asking us, what's going to happen with the U.S. economy in 2020. We have a big presidential election. The market's coming off of a good year. Should we continue to invest? How should we structure the portfolio? These are types of the questions I hope to address today. And as I said, if you do have any questions about what I'm presenting, please type it into the webinar functionality, or of course, just give us a call and we'll be happy to go a little more in depth into anything that you might want to consider. So this is a fourth quarter 2019 slide of just the fourth quarter performance. It was a very strong quarter. U.S. markets all the way across the board, international emerging. We had really good returns, and some of this was mostly due to, I would say, a couple different factors that really happened in the late third quarter, early fourth quarter. We had the Fed cut interest rates one more time, making that 3 cuts for the year as far as the interest rates are concerned. And then, it's been back and forth in the news all feels like for many years, but very strongly in 2019 with talks of tariffs. We started to see that the U.S. and the Chinese coming into some sort of tariff agreement, and this all led to stocks popping up in the fourth quarter here. And in the bond markets, we had the U.S. bond market up slightly, and we did see some downturn in global bonds with some higher rates in many countries that have previously had negative interest rates. So we saw a couple countries actually cross over into having positive rates, and then I guess we'd say we have less negative rates in Germany and some of those European countries where their rates starting to creep back towards zero or a more positive stance. So, taking a look across the year, just some headlines that we've experienced in 2019 that led to such a tremendous year and positive year in the stock market. Just a quick, we have to revisit quickly 2018 and how that was in the S&P 500. In 2018, that was one of the worst years since the financial crisis back in 2008, 2009, as far as returns in the S&P 500. S&P 500 being a barometer of how the U.S. market is performing. So we're coming off a pretty bad year in 2018, and we had turned into a great year in 2019, despite some of these headwinds with trade, with interest rates, with if we're looking at some of these headlines back in around August, we had the Dow shed 800 points in one day. So the volatility was there, but ultimately, the economy and the markets held on, and we had a really good year for 2019. How good of a year was it? Well, the S&P 500 was up 31%. 31%. That is a good year by historical measures, by anyone's measures, very excited that the U.S. had such a positive year in the markets. And so that kind of carried through across the globe. 2019 and the U.S. dollar terms, we had the Europe, Asia, the Far East, developed countries do over 22%. We had emerging markets over at 19% as well. And so we had some really strong returns across the globe. So we started to have, with some of these trade agreements, we started to see some coordination, some global growth coordination. So, it was just really a positive year. And then in my slide here, you can kind of see the red, just contrasting that back to 2018 again. It's just a tale of two different years, where now if you look back to 2018, the S&P 500 was at -4%, some of the -13, -14, and some of the broader markets abroad. So, it just kind of goes to show that it's hard to predict these yearly movements in and year out. And so having that developed investment plan throughout the years is really the key to success. And we'll go into that more a little bit later. This is always interesting to me, the World Country Index by market capitalization. You see the United States has 56% of the world's stock market capitalization. This is actually up over the past few years. Back in 2017, it was about 52%. Now we're up to about 56%, and that's a combination of just stronger growth in the U.S. and more issuance in the United States. So the emerging markets, people often say, well, what does that even mean? So the emerging markets are countries like China, India, Brazil, these up-and-comer, high growth, high GDP growth type of countries that maybe has a bit of less debt on their books as well. Bond markets, fixed income, this is a similar term. It's the same term. So the bond markets, what do they do in 2019? And they also performed very well. So it was one of these years where both the bond markets and the equity markets were moving in the right direction. So if we're on a balanced portfolio approach with a mixture of stocks and bonds, you saw positive results in both areas. One of the reasons that we had such a positive return in 2019 on the U.S. aggregate. The U.S. aggregate returned 8%, and the aggregate is kind of a mixture of corporate and government bonds. It's kind of like the S&P 500 in the stock world. In the bond world, it's called the U.S. aggregate, and it was up 8%. And as a reminder, this happens typically when rates go down, the value of bonds go up. Because if new bonds are being issued, say, at 2%, and you're holding a bond that was previously issued at 4%, well, your older bond is now worth more and is more valuable. And it's really just kind of a tale of two different worlds again. In the 2018, we saw the Fed continuing to raise interest rates, and that was the forecast year for 2019 by many folks. Yet, in hindsight, being 2020, that kind of got turned upside down with the Fed becoming more accommodative and even easing and cutting rates throughout the year. So the bonds did well as just as well as stocks did, and so most people are pretty happy at the end of the day, at the end of the year, about how their portfolio performed in 2019. So what are clients asking? Will the United States head towards a recession in 2020? Let's take a look about how long this expansion's been happening and what kind of economic outlook we've been doing here in the past few years. So on my left here is we've had a historically long expansion in the economy. This ranks up to the 126 months of a positive GDP growth without a recession. And so as you can see on this chart here, the average expansion is about 48 months. And when those nasty recessions do come, and they're going to come again, that's just the way that the economy ebbs and flows. They typically last about 15 months. So what is still, you really can't just say, we're due for a recession just because of the length of time. Nothing does last forever, but that wouldn't be the only thing to say. There's no real data behind saying we're due. You have to kind of understand what kind of expansion we've been having. When you look on the chart on the right here, this light blue line on the bottom of the right chart of how many quarters of cumulative GDP growth, you can see the incline or the shape of this line here is smoother or flatter than previous expansion. So what does that means? That we're having a longer expansion, but we're also having kind of a slower expansion where we're seeing 2 to 3% GDP growth here in the United States, whereas previous expansions, they might have been a little bit hotter. Remember the days of 5%, 6% GDP growth here in the United States. So we're having a longer time frame for expansion, but it's also slower growth. So that's the type of expansion that we're having. And some of the economists that we listen to and study and follow, one of my favorite expressions is that you can't really get hurt too bad from an economic standpoint by jumping out of a first floor window, meaning that we've had good growth, but nothing really seems to be that overvalued, or nothing is smacking us in the face and saying, wow, the consumer's way overextended, or the housing bubble again. These are types of things that would alert us to perhaps bubbles in the economy. But right now, it seems pretty smooth. So kind of our base case, what we're expecting from the U.S. economy is, again, more slow and steady. It's more slow and steady growth. 2% growth is not gangbuster growth, but at least we're growing. That's kind of the target of many economists out there, 2% GDP growth. And the reason why is we still have a good consumer. The consumer, the U.S. economy, typically makes up about 2/3 of the U.S. economic outlook. So 2/3 of our production and our output is measured through the consumer. And the consumer still seems pretty healthy. We have a chart here with the unemployment rate, which is the darker gray line, sloping down way back from October 29, 2009, when the unemployment rate was up around 10%. Fast forward 10 years later, we're at historically low unemployment with a 3.5% unemployment. And then the blue line, which is really telling as well, which is wage growth. And back in November 2019, we had 3.7% wage growth, which is creeping up to the historical average of 4%. So it seems that the consumer is employed, they're getting paid better, and we have an interest rate environment that's still accommodative. The Fed did cut interest rates 3 times last year, so we have still historically low interest rates. So we're looking at pretty much, we think, a positive global, not only U.S. economic picture, but also now a global growth as well. The IMF, the International Monetary Fund, predicted, it recently came out, somewhere around 3% growth for the world economic growth as well. So it's going to be more slow and steady, wins the race. So what are some things that might damper us? The unknowns, I would say. We've had this recent case just in the news this week about the coronavirus coming out of China. What long-term or how deep of a worldwide illness or spread of that contagion, what will that have ultimate effects? I mean, that could be something like that. Iran coming, geopolitical events in the Mideast, these types of things that no one really can predict would be a damper to the global economy. Trade wars, trade tariffs as well would be something that would threaten the global economy. And, of course, corporations have been spending to beef up their capital expenditures and investing in their companies. So everything right now seems to be on trajectory for a positive economic growth year here in 2020. So yeah, the big thing that I didn't just mention as far as our economic outlook is, what about this presidential election? It's happening in November 2020. It'll be here before we know it. So what is happening how could that affect the economy? How it could affect your portfolio? I think I'm going to start it and end it with this phrase here. Don't let your political view shape your investment perspective or shape how you're going to invest. Typically what we see, and we work with both sides of the political aisle. People that with their parties that are in power, they seem to be more optimistic and perceive the markets to be less risky, and this might lead them to take on more risk and overweighting towards riskier sectors in the stock market. And just probably not surprisingly, but vice versa, when your party is not in power, you kind of feel a little bit unease, a little bit more uncertainty, a little bit more just angst about the overall economy. The best story is, going back to when Trump was first elected, the general consensus on election night, and a lot of people were scared about it, was that the markets were going to go down. And if you stuck to you let your political views on how you feel about the current president shape your investment portfolio, well, the market has the U.S. market's been up about 50% in the last 3 years. So, you really want to stay away from that and really try to, separate your politics from your investing. It could really be detrimental if you let your politics lead your investment philosophy. Just some general averages here. It's really hard to predict. I mean, I'm not saying this is just averages, but there's of course exceptions to the averages. This is the chart from 1928 to 2017 about the returns during the election year. So during the election year, on average, over this period of time, election years have returned about 11% in the U.S. stock market. And then the years subsequent to the election, no matter who got elected, it was another 9% or closer to 9.9%, 10% on average. So, on average, these are good years to be invested. But again, there's definitely outliers and different things happening in the economy. You have to separate the economy from your politics, from the markets. But this is an interesting chart, and so I guess if history does tend to repeat itself, we're looking for another good year here in 2020. By the way, the average return typically over this time frame in the S&P 500 is typically about 10%. So, that's what we kind of expect anyway for 2020. Is kind of if we just stuck to the averages, we're expecting about a 10% return in the S&P 500 for 2020. More to the point, this is broken up between red Republican presidents and Democratic presidents dating back to the 1920s, and you can kind of see, whoever's in charge, capitalism works. Capitalism is what leads the markets and what leads the free markets to have a market to create capital for companies and for long-term investors to be rewarded as they're putting their money at risk in the stock market and investing into these companies. There is a risk premium to doing that. Otherwise, you just keep your money in cash. That's why you invest, is to get those long-term profits. So, we're going to stay out of politics, and we're going to not let our politics sway how we're going to manage our portfolios. And just another note on timing. It's really it's hard to get it right both times. If you do sell because of a political view or some sort of market event, it's really hard to get back in. It's hard to time it when to get back in properly. I mean, it's very rare that you get it right twice, that you call it the top and you sell out and you buy again. So, we use any downturns to really rebalance the portfolio. So, markets are at all-time highs. They just keep climbing. It is still now a good time to invest. Let's just take a look at some long-term historical results here from different types of markets. As you see, the 1-year row on the top row there is just the 1-year returns that I've kind of gone over today already. 30% in the U.S., average 20% abroad, and bond markets were up. And then over the last 10 years, the decade of the tens, I guess that's what you'd call it, the 2010 to 2019, we've had a return in the U.S. markets of 13%. And you can contrast that going back to the 2000s, where we had a lost decade. So that's we had a negative 1% return in the S&P 500 from 2000 to 2009. Yes, we've rallied back strong, but I'm sure there's folks on this call that remember Dow 10,000. They might maybe remember Dow 5,000. So just over the course of time, slow and steady wins the race, and markets do appreciate. We had not quite a lost year in the emerging market sector, but over a 10-year period, it's been 3.4%, 3.6% return. And so, it's really got to think about your time horizon. There's another chart here this is an interesting chart from our friends over at BlackRock that I wanted to share today. And this takes a minute to understand what you're looking at, but let me try my best to explain it. So we're looking at rolling 20-year returns dating back to 1945, and every 20 years, that's where the orange line is. So every 20 years, those are returned, which makes up the data points. So the top of there is that back in November 1999, the time period from 79 to 1999 was really strong, and that averaged an 18% return. As I said, the last 20 years for us, we've experienced 10 years of a lost decade. So you're at negative 1% in the early 2000s, and now we had 13% in the last 10 years. So if you look at that over a 20-year period, we've had a return of 6% since early 2000. As you can see, the average of the 20-year time frame is kind of similar to the S&P 500 historical average, which is around 10%. Now, what does that tell us? Now, it just kind of goes to show that on the right side of the chart here, you can see, look at returns following 20-year returns. If you buy when the 20-year return is less than 8%, which is where we're currently at, 20-year return right now is 6%. If you forecast that out or put that out, extrapolate that out another 20 years beyond that, an average return at that is 14.8%, and a minimum return for the next 20 years is 11%. Contrast that what I just described as, maybe 1999, or I guess back in the 60s, they had some, good 20-year periods. If you were buying in when it was more than 12%, your historical returns were, of course, less because you were buying in at a higher price. Therefore, you had a higher likelihood, they would just have to have more oomph to get more returns back then. So when you think about, yes, the markets have done well. We had a 31% year. Matt, we should take some off the table here, maybe get a little more conservative. Maybe. Yes, we should have that conversation. I mean, we had a good year, but we really got to match it up with your goals and what this portfolio is really doing for you as an investor. That's the main part of the equation here. We're not going to try to time the market and say, okay, we had a 31% year. Now we're destined to have a negative year and get really conservative. We're taking a balanced approach as we normally do here at Tobias Financial Advisors, but we're not going to get overly conservative at this moment just because we had previously a good year. And for folks that have cash on the sidelines, your cash, if the Fed anticipates an inflation of 2% going forward for 2020, and your cash is only making, at a kind of a high yielding money market type of thing, you might be getting 1.5, 1.6. If you're stuck at your local bank down the street getting, 0.1%, your money is not keeping up with inflation. So we have to balance how much we keep on the cash and sidelines versus how much we're going to put to work in the market. And that's the thing that we normally do here at Tobias Financial Advisors when we work with your advisor and kind of go through those adjustments and that thought process. So this will be my last slide to kind of hammer that point home. It's very similar kind of story, is that over the longer term periods, the markets reward you. And you see across here at the bottom a 1 year, a 5 year, a 10 year, a 20 year rolling period. Yes, in 1 year, and the green line, the stock market is very volatile. You could be up as much as 47% or down as much as 39% if you're investing for only 1 year. I would tell you probably not a good idea to put in the market unless you really just didn't want to sleep at night. So what you have to do is if you build a balanced portfolio, and there's the gray bar, the blue bar is bonds, and the gray bar is a mix of bonds and stocks. So over a 1 year period, yeah, you could be up, you could be down. As you move forward through time, over a 5 year period, you can see a balanced portfolio ranges from 21% to 1% annualized, and so on and so forth. So, over 20-year periods from 1950, this has been a positive return for long-term investors. So, some 2020 outlook. I was kind of dropping some of our expectation, in particular in the U.S. economy. We're entering in the 11th year. We're marking the longest expansion since the 1900s, and we just recently experienced the only decade without a recession. We don't really guarantee anything here at Tobias Financial Advisors as it comes to market returns and economic outlooks, but at some point in the future, we're going to have a recession and come back to see us again. We'll be ready for that by utilizing a balanced portfolio. But as of now, it looks like the consumer is ready to go for another year, and the inflation outlook is stable and the interest rate outlook is stable. So we think we're going to have good U.S. growth. Throughout the slides here, you've kind of seen an over or outperformance over the last 10 years in the U.S. markets compared to overseas, developed, and emerging markets. We think that based upon valuations, the emerging markets and the international markets come at a better value. And with a U.S. dollar that seems to be kind of stable or maybe even weakening if other countries start to get into a period of raising rates, this looks to be a catalyst for international investing. So we would like to, you should probably consider having that part of the world or the global investing story as part of your portfolio as well. U.S. Valuations, they look okay. They're not overly expensive, but at the same time, we just want to be careful that we're not going to put all of our eggs in one basket. This is not the time to really get too weighted towards one sector. It's not the time to take a lot of risk. If you hadn't had a hurricane hit Florida or some sort of natural disaster and you're wherever you're living for the last 10 years, are you not going to pay your homeowner's insurance that year? No, you're going to pay your homeowner's insurance because you want the protection in down environments, and that's what a balanced portfolio does for you. That gets the diversification. Bonds, again, they had a good year last year. People may be tempted to go out into the maybe lower quality bonds to pick up a little more yield. We do that to a degree in our portfolios, but we're doing it in a balanced approach. So just be careful if you hear, oh, you can get 10. I got a guy get me a 10% bond. Well, yeah, you probably could find that out there, but the credit quality and the risk associated with that bond would be something to definitely analyze. And let's see if we have any questions rolling in here. We do have, looks like we have one question coming in here. It's kind of about the value versus growth tilt in the equity markets here. And so, yeah, growth and technology has been outperforming pretty significantly the past 10 years here, where a lot of tech companies have, and due to the low interest rate environment that we've been in here, a lot of people have been reaching for growth, which usually consists of kind of those higher earners that don't hire more risk or more speculative companies that maybe don't necessarily pay a dividend, but you're investing for more growth. And we think that the valuations for value stocks will start to come around. In fact, in 2019, depending on what metric you looked at, value started to outperform growth towards the latter part of 2019. We think this may continue in 2020 as potentially the U.S. interest rates become more normalized, that higher interest rates are better for financials and some of the other sectors that we're watching as far as the value versus growth tilt. So we do have, we have exposure to both, but we do have a historically value tilt towards dividend paying and quality companies here at Tobias Financial Advisors. So it'll be an interesting year going forward. We will, we've seen already the resiliency in the markets already in January with what I've mentioned before, kind of the Iran conflict that seemed to, didn't quite get to war, thankfully, but the market's already bounced back from that already. And we will see, and we will continue to watch the markets as the year unfolds. And please reach out to us with any questions, comments about what's happening in the markets or what's happening in your personal financial life. We want to thank you for attending today, and we look forward to celebrating our 40th anniversary with you this year. And we wish everyone the best for a happy, healthy new year. Thank you. Goodbye.